One of the most misunderstood areas of Nigerian tax law is when income is taxed. Not how much, but when. Many tax disputes, additional assessments, and penalties arise simply because businesses and individuals apply the wrong basis period. This small mistake can lead to double taxation, missed income years, and prolonged, costly arguments with the tax authorities. Welcome to A Stitch in Tax, Saves Cash, the channel where we break down Nigeria's tax laws in clear, practical terms that help you stay compliant, reduce disputes, and save cash legally. My name is Olatunji Abdulrazak, founder and CEO of TaxMobile Online, a professional tax knowledge platform supporting taxpayers, tax professionals, and tax administrators across Nigeria and Africa. In today's episode, we are examining Sections 22 to 26 of the new Nigeria Tax Act 2025. These sections are the foundation for determining when your income hits the taxman's radar, covering basis periods, commencement, cessation, changes in accounting dates, and special rules for individual income. Understanding this isn't just academic, it's fundamental. Tax is not just about how much you earn, it's about when the law says that income becomes taxable. Getting the timing right is half the battle won. So, let's start with the cornerstone, Section 22, the General Basis Period Rule. This section establishes what we call the preceding year basis as the default for assessing business profits. What does that mean in simple English? It means the profits you make in one accounting year are taxed in the following year of assessment. For example, if your company's financial year ends on December 31st, 2024, the profits you made during that year will be assessed to tax in the 2025 year of assessment. It's a look-back system. The government assesses your past performance to determine your current tax bill. But what about new businesses? Section 22 has a special rule for them. If you've just established a new business, your profits are assessed from the actual date you commenced operations right up to the end of your first chosen accounting period. This rule is designed to ensure there's no gap. From day one of your business journey, the tax clock is ticking. You can't start a business in January and say you'll only start accounting for tax in your second year. The law captures that income from the very beginning. Now, let's move on to Section 23, which deals with something many businesses consider, changing their accounting date. Maybe you want to align with a new parent company or you've found a financial year-end that better suits your business cycle. The law allows this, but it doesn't allow you to use that change to create tax loopholes. Section 23 sets up a transitional rule. When you change your accounting date, the tax authority needs to create a special basis period to bridge the gap. This period runs from the end of your old basis period to your new accounting date. This ensures no income falls through the cracks between the old and new systems. But here's the crucial part: you must notify the tax authority of this change. The law is very specific. You need to provide this notification at least 30 days before you file your tax return using the new date. If you fail to do this, the tax authority has the right to reject your new basis period and can even impose penalties. The message is clear: transparency is key. Changing your accounting date is a strategic business decision, but it must be done in partnership with the tax office, not behind their back. Next up is Section 24, which covers what happens when a business ceases to operate. Closing a business doesn't mean your tax obligations just disappear. In fact, it triggers a final set of rules to make sure all accounts are settled properly. The core rule here is that your final profits are assessed from the beginning of your last accounting period right up to the actual date of cessation. So, if your accounting year normally ends in December but you cease operations on June 30th, your final assessment will cover the profits from January 1st to June 30th. And the tax on these final profits must be paid within 6 months of that cessation date. But business doesn't always end cleanly. What if you recover a debt or settle a liability a year after you've officially closed? Section 24 anticipates this. Any income or liabilities that are finalized after cessation are legally deemed to have occurred on the last day just before you ceased business. You are required to disclose these post-cessation adjustments within 1 month of them happening. This rule ensures finality and prevents income from escaping tax just because it was received after the doors were shut. The same logic applies to deceased persons. Any income or liabilities related to their trade are treated as arising on the last day before their death, ensuring the estate can be settled correctly from a tax perspective. Now, let's talk about a common tax planning, or sometimes avoidance, area that Section 25 addresses. This section introduces a continuity rule for individuals. It's designed to stop people from creating artificial cessations and commencements to gain a tax advantage. Here is the rule: an individual is not considered to have ceased one business and started a new one just because they changed their tax residence or because they joined or left a partnership. As long as the underlying trade or business itself continues, the tax assessment also continues uninterrupted. You can move from Lagos to Abuja and claim you've ceased your Lagos business and commenced a new one in Abuja if it has the same operation. Similarly, if you bring a new partner into your firm, the business hasn't ceased. The law looks at the substance of the business, not just the structure of your personal involvement. Finally, we arrive at Section 26, which outlines the rules for the assessable income of individuals, and it's a bit different from business profits. For employment and pension income, the rule is a current year basis. This aligns perfectly with the pay-as-you-earn, or pay, system. Unlike business profits that are taxed in arrears, your salary is taxed in real time. What you earn in 2025 is taxed in 2025. The law even gets more granular, stating that employment income accrues on a daily basis. For lump sum payments like bonuses, commissions, or terminal benefits, they are taxed on the date they are paid. Or, if they are paid after you leave the job, they are taxed as if they were paid on your last day of employment. What about other income streams for individuals? For capital gains, the general rule is the preceding year basis, similar to business profits. However, if the asset you sold was used in your business, the capital gain is aligned with that business's accounting period to keep things consistent. For income from trusts and estates, which is paid to trustees, executors, or beneficiaries, the rule is also the preceding year basis, governed by the detailed provisions in the fifth schedule. This ensures continuity and prevents income from leaking out of the tax net during estate planning. So, let's do a quick recap of the key takeaways. Business profits are generally taxed on a preceding year basis. New businesses are taxed from their actual commencement date. If you change your accounting date, there's a transitional basis and you must notify the tax office. When a business ceases, profits are assessed up to the date of cessation. And remember, changing your residence or partnership status doesn't create an artificial cessation. For individuals, employment and pension income are on a current year basis, while capital gains and trust income typically follow the preceding year basis. As a practitioner, my advice is to always confirm these three things for your clients: their exact commencement date, their accounting year-end, and the specific nature of their income. Errors in basis periods are a major compliance risk. Getting them right from the start reduces disputes, minimizes the chance of an audit, and ultimately saves you and your clients a lot of headaches and cash. If this episode has clarified how basis periods, commencement, and cessation work under the new Nigeria Tax Act 2025, then it has done its job. The right timing is everything in tax. Please like this video, subscribe to A Stitch in Tax, Saves Cash, and share it with a business owner, finance manager, or any tax professional who is preparing for the 2026 tax regime. Your support helps us create more content like this. I am Olatunji Abdulrazak, founder and CEO of Taxmobile Online, and I will see you in the next episode. Thanks for watching.